I feel like the market is not gonna go up. As I've said, in the short term, maybe it will still go down. But then when you buy today, think long term. I wrote a column about what do I mean by long term. Is it 1 year, 2 years? It's more like a mindset that this is a stock that you would like to keep for a very long time. This is your opportunity actually to own an asset which is managed by somebody you admire a lot, say by the Taipans that you wish were your partner. This is the time that you can actually be a partner with them for the long term, no? At prices which you would not be able to buy if it were not for a crisis. Let me start out by talking about the market, how it has performed. So you can see how the market actually, after falling sharply initially, it has rallied quite a lot. And I guess in some ways it's justified because last April, May, we actually saw how the number of cases actually flattened. So we successfully flattened the curve, and not only us but the rest of the world. So it has allowed the global economy to reopen. So it created a lot of optimism, so to speak. And then, of course, we saw a lot of um, vaccines and treatments that are gaining acceptance, or at least showing some signs of improvements. So in a way, it created this feeling that the worst is over. Okay. However, that said, I don't expect the strength to be sustainable of the market. And this is because, first of all, I don't expect the economic recovery to be V-shaped. I'm expecting it actually to be more of a U-shape, or to be exact, more like a Nike swoosh type of shape, which is exactly how you answered it, or most of you answered it. You expect the new normal to materialize, or actually the 2019 scenario to materialize towards the end of 2021 rather than in 3 months or 6 months. Okay. And aside from that, I think Mr. D has discussed how our stock market is heavily weighted towards traditional businesses. And finally, foreign investors are still not yet in the Philippines. They are still net sellers in the Philippines, and in the past, we actually have not been able to sustain a recovery with the foreign investors not present in the country. Okay, so first of all, we know how COVID-19 has a severe economic impact in our country. As you can see here, during the first quarter, we were only in a lockdown for 2 weeks, and yet we reported a 0.2% contraction in our GDP. Um, so, what more can we expect in the second quarter? That we were in a lockdown for essentially the whole month, an ECQ for um, almost 1.5 months, and an MECQ for 2 weeks and GCQ for 1 month. So essentially, we expect second quarter to be bad. And well, the thing is, cases continue to pick up. As you can see, after initially showing signs that we have flattened the curve, you can see how the daily new cases are picking up. I mean, previously we were doing probably 300 cases a day. Now we're doing 1,500 to 2,000 cases, and on some bad days up to 2,500 cases. So with that, you would be worried, because if we look at this, diba, the government will always say we will rely on science to determine whether we will lift the GCQ or whether we will return back to ECQ. So if we follow this definition of what should happen for us to exit the GCQ, I think we won't be exiting GCQ. In fact, I think Harry Roque was quoted as saying, if we exceed 85,000 cases by the end of the month, we actually could go back to ECQ, or the NCR could go back to ECQ, which is quite scary. And it is a possibility because right now, of course, if you look at this framework, our critical care utilization rate is actually above 70% in the NCR region. And I guess, I mean, we've successfully exited ECQ for a while. So just to refresh everybody's memory, why should we be worried about returning to ECQ? Well, um, during the ECQ period, remember, no public transportation was available and dine-in was not allowed. And several businesses were forced to open at even lower capacity. So if we return to ECQ, that is what will happen. And I don't know if a lot of businesses can cope with a return back to a stricter lockdown after enjoying a bit of normalcy under the GCQ scenario. Okay. And even if the government actually allows people to still go out, because what is happening right now, of course, they're relaxing the rules of what is part of a GCQ, right? They're allowing, say, higher capacity of, say, parlors, restaurants, etc. Even if they relax these definitions, the concern is, if the cases continue to go up, people will still avoid going out due to worry of getting sick. So I think yesterday there was news that according to the SWS survey, around 85% of the people surveyed were worried a lot. I think worried a lot about getting sick or catching coronavirus, like what to do. So it really is worrisome. So in light of that, it's hard to expect investments or businesses to actually increase investments because there's so much uncertainty going forward with the number of cases still going up. And of course, for people, there's also uncertainty about their jobs. Businesses won't be hiring. People are worried that they may lose their jobs, and therefore they will not spend. Okay, so that's one side of it. The private sector is really very cautious at this stage. And of course, our hope really is if the government does do some stimulus programs. The problem is our government is very much worried about its finances as well, because with weaker economic conditions, of course, the revenues that it will generate will be much less. And with lower revenues, um, our government is actually, on the positive side, very disciplined because it doesn't want to overborrow and overspend, uh, on the positive side. But on the negative side, this just means that we cannot count on the government to, um, aggressively pump prime the economy. So I'm just sharing with you this the plans of the DBCC based on May, where it revised the revenue targets and of course the disbursement targets. And you can see how the spending from 4.2 trillion in 2020 will be flattish in 2021. Just recently they increased it to 4.3 trillion, but then again from 4.2 to 4.3, that's only a very low increase. So from 4.2 in 2020 to 4.5 to 2022, that's a 3% CAGR. Unlike before, the growth is actually around 10% per annum. Okay. So aside from that, you can see how our debt to GDP ratio actually increased from around 40% during the end of 2019 to 50% by end of 2020 or end of this year. And even if the government is going to be frugal the next 2 years, our debt to GDP ratio is growing, which is why the government is a bit hesitant about um, doing much stimulus. I think the objective of the government right now is to pick and choose and to reallocate spending towards projects that are expected to have the biggest multiplier effect rather than to do what, say, the US is doing, which is giving out money to people. I don't think we'll have part two of the SAP. No, so looks like that's how it will go. So if you remember your lessons in college where we talked about GDP being C, consumer, I, investments, G, government spending, and of course exports. Um, it looks like we can't count on any of those, at least, no. So economic growth again is not going to be V, but rather U-shaped going forward. So because of that, I don't expect the market to be strong, at least in the short term. And next, the Philippine market is heavily weighted towards traditional businesses. So if you look at the market weighting of the PSEI index, you will notice how the traditional businesses or like financials and real estate account for around 44%. Actually, the others would include your consumer companies, power, industrials. Well, the industrials broken down is 39% SM and 15% Ayala Corp, 14% JGS. So these companies are actually very heavily consumer related, property related, and financials related. So really, we are very heavily weighted towards traditional businesses that are sensitive to the ongoing crisis. So because of that, our weak performance is actually not surprising. If we look at some Asian indices, so I got the information here from Bloomberg. This is the performance of selected Asian indices as of last week. I picked the strong performers, which was Shenzhen, South Korea, Taiwan, and those are the indices, okay? And the weaker performers, such as Indonesia, Thailand, Philippines. And you will notice that for the three weaker indices, we are quite heavily weighted on financials and real estate, okay? And for the three stronger indices, okay, would you believe Shenzhen is actually up 25% for the year to date? South Korea 16.9, Taiwan, well, 1.5%, but it's still up, notwithstanding everything. They have quite a big exposure to the IT sector and the healthcare sector. So although the financials and the real estate companies there are also suffering, the fact that they have exposure towards these sectors is helping, um, you know, pull up the performance of those markets. And unfortunately, the foreign investors, after momentarily buying emerging market stocks, because of course we know how these tech stocks are now so expensive, they actually came here for maybe 1 week. You can see 1 week in June they were here, but after that they stopped buying Philippine stocks, and again, the value plays stopped, and they're still selling the Philippine market, unfortunately. And as I've said earlier, it's difficult to imagine the Philippine market sustaining the strong performance without foreign investors. Um, I think one of the concerns, of course, would be a little bit of it doesn't help that there are regulatory issues right now. I think among them, for example, the government has been talking about how they will be um, taxing junk food. That's one issue. Secondly, it's not yet clear how the water contracts will be addressed, although it seems like they will be quite strict about it, um, to favor the government. And I think what happened with ABS, of course, is also worrying some investors. Okay. But notwithstanding our concerns in the short term, we're not expecting a retest of the previous lows. I know in the past, I've said that, in past crises, we've seen the market going down to 8 times PE. But this time around, there is a possibility that we may not return to the 4-6 level, which is where the 8 times PE is. Because first of all, financial conditions, they are better versus the previous crisis. And secondly, um, we're approaching 2021. We're already in the third quarter of the year, and in a few months, it's going to be the Burr month, and it's going to be fourth quarter. So people are going to look towards 2021, and profits are going to be better for a lot of companies next year. And added add that to lower interest rates, stocks are looking more attractive from that perspective. So, those two factors, I think, will allow the market to not go down as much as they did in the past. Okay, so let me explain this further. Okay, on the financial conditions. So first of all, surprisingly, I think a lot of people are so surprised the peso now is strong. And the 10-year bond rate is actually lower, a lot lower. So you can see right now the peso is at 49.4. The 10-year bond rate is at 2.7%. Like, we were actually just talking about it here in the office because I remember when I started becoming conscious about interest rates when I was young, the savings account rate was 2%. But now, if you try to get or put your money in time deposit, you only get 1%. And you're happy with the 1% time deposit rate. So I never thought I would see interest rates go down this low. And not during the time of a crisis. Okay. So just some positive implications. First, because the peso actually strengthened and interest rates are low, this reduced insolvency risk brought about by rising inventory costs, rising funding costs, refinancing, and liquidity risk. So, you know, when I was a young analyst before, I of course I wasn't aware that during times of crisis, actually, um, if coincidentally you have a lumpy maturity during the time of a crisis, you cannot refinance your debt, and you will be forced to refinance it at a very high cost. So when this crisis actually started, one of the things that we did as a team was to look for listed companies which had lumpy maturities of debts, those that needed to be refinanced this year or next year. And secondly, those that are very sensitive to a weak peso. And so we were very much concerned about that, and companies with high levels of debts. Okay. So, but then if you look at the next chart, surprisingly, everybody and anybody who needed to refinance their debts actually were able to refinance their debts, and at, in fact, very low rates. So you can see here, these are the recent corporate bond issuances. um, in March, you look at the interest rates. Say SM Prime borrowed for 5 years and the coupon was 4.8%. Okay, scroll down, look at RLC, who borrowed the latest, and the 5 years is cheaper by 100 basis points, 3.8%. Okay, so in past crisis, this never happened. If you wanted to borrow money during during crisis, it is always so much more expensive. But this time around, thanks to the Fed, who's very aggressively doing a quantitative easing, buying everything, including junk bonds. Rates are going down, refinancing has become easy. And of course, our own BSP has been very aggressively cutting rates and cutting the triple R's, or reserve requirement ratios, and also buying back bonds. So this is to the benefit of companies. So that's one problem that does not exist. And if you look, of course, at the dollar bonds, so you can see how the dollar rates are even so much cheaper. For example, PLDT was able to borrow for 30 years at only 3.45%. Okay. So that's really a very, very low rate. The telcos, I think, right now are considered to be the strongest because of the demand for data. No, so Globe was able to borrow for 15 years at only 3%. So these are rates that are unheard of before. No, so that's one problem that we're not seeing this time around. Okay, and well, another reason why stocks have become more attractive is because, of course, valuations of stocks are attractive relative to bonds. Um, so, when interest rates are low, of course, stocks become more attractive because what you're earning from bonds, time deposit interest rates is very low. So I computed for the earnings yield or earnings over price less the 10-year bond rate. And right now, there is a spread of 2.9%, which, if you look at the past 10 years, is actually the highest it has been, which means that stocks are really very attractive at these levels based on valuations. Okay. And notwithstanding, my very bearish near-term outlook, um, you know, we we actually started to do some computations with my analyst. I said, when we started the crisis, we thought that interest rates would go up. So we increased our risk-free rate assumption aggr- aggressively to around 6%. But now I said, let's cut our risk-free rate assumption to something much lower, say 4%, and let's see what the 2020 target of the PSEI will be. So we did a bottom-up target for the PSEI, and for next year, if we were to roll everything to next year, our N21 target is actually 7,000, and this has an implied PE of 15.3 times, which is minus one standard deviation below the mean. Or anyway, so to put it in more layman's term, it's still within the low end of the range if we look at the PEs of the index. And this is actually around 15% higher than current levels. So not bad, which is also in line with what you guys said a while ago when you were surveyed. You said that you expected the market to be in a weak bull. And, based on numbers, looks like that will happen. Problem is, of course, some of you, the more skeptics will say, yeah, but the 2021 earnings are still subject to downside risk because we don't see much visibility. That said, I agree that it is concerning because from 6,000 to 7,000, that's just 15%. Eh, mag-minus 10 ka lang ng earnings, eh, di parang wala lang, di ba? But that said, just like to highlight that there are actually opportunities to buy cheap stocks. And those are companies from the vulnerable sectors because they're really cheap. Whereas what's making the market expensive really is a few large cap issues that continue to trade at very high valuations. So I'd just like to recap what I've shared in the past. How do we define the resilient sectors? Those are retailers of essential goods, like the mga grocery stores, which we continue to patronize. In fact, I would think that we go to groceries more often right now because we cook more at home rather than eat out. Then, of course, you have the food manufacturers and the telcos because we actually are using data so much more right now. And to a certain extent, utility companies, water companies, power companies. On the other hand, we have vulnerable sectors such as the retailers of non-essential goods, such as clothing, di ba, mga shoes. And then you have the restaurants, people avoiding eating out right now. And then, of course, property companies, especially mall operators, hotels, and the banks, which would encounter higher NPLs and lower margins. Okay, so So again, if we look at the PE ratios of stocks, you will notice if we do a breakdown of the index, the large cap issues are actually very expensive, like JGS, SM, no? Those actually account for a very large share of our index. Okay, and even AEV or SM Prime, and they're expensive. But if you look more towards the right side, you will notice how companies that are considered to be vulnerable to COVID, that are not among the favorites or the large caps, they are actually trading at very cheap valuations. So my point here is that there are opportunities to buy cheap stocks that are vulnerable, or they are vulnerable, but they are at levels that you would like to keep for long term. I mean, if you're willing to hold on to it for, say, to buy it and forget it, they are actually at those levels. And notice on the middle part, the resilient stocks are actually not that expensive either, like your Globe, PLDT, Pure Gold, you know. So I think there is an opportunity to buy them at this point. Okay, so that said, my strategy or my recommended strategy is first, to stay invested. Um, and second, if you want to buy stocks in the resilient sector, or you're more of a trader type of investor, you're an active trader, active investor, I think you can buy some stocks, but stick to the resilient sectors, those that will continue to generate earnings growth the next few years. And for companies that belong to the non-resilient sectors, I think there's a good opportunity to start accumulating, but then manage your risk by buying slowly, because I feel like the market is not going to go up. As I've said, in the short term maybe it will still go down, but then when you buy today, think long term. I wrote a column about what do I mean by long term. Is it 1 year, 2 years? It's more like a mindset that this is a stock that you would like to keep for a very long time. This is your opportunity actually to own an asset which is managed by somebody you admire a lot, say by the Taipans that you wish were your partner. This is the time that you can actually be a partner with them for the long term, no? At prices which you would not be able to buy if it were not for a crisis. And of course, to diversify, and finally to limit your size, because potentially you could be holding on to this position for a very long time. So I'll first start with the resilient stocks. So one of the stocks that we like, of course, is Pure Gold. Mr. Lee already discussed this. Um, One of the reasons we like it is because of its sustained sales growth amidst the increased demand for essential goods. Um, and the strong peso right now is actually beneficial for SNR because they sell imported goods. So that would mean higher margins for the company. And aside from that, Pure Gold is actually a company with a very strong balance sheet. It has no debts, or well, minimal debts, to the point that it actually has more cash, or it's in a net cash position. And in terms of PE, Pure Gold is trading at 17 times PE this year. In the past, it traded at an average of around 21 times PE. Okay. So the next stock that we like is CNPF, the manufacturers of Century Tuna. Okay. It is a main beneficiary of increased demand for essential goods with its shelf-stable products. Okay. So it manufactures Century Tuna. Aside from that, it has sardines and corned beef. And it also manufactures milk under the Birch Tree brand. And what is exciting about this is that its market share has grown from 2% in 2016 to 22% in the first quarter of this year. So because of that, that segment has been growing actually by around 20 to 30% the past few years. And the margin outlook is very good because they've locked in costs at low levels. And it also has a strong balance sheet with minimal debt. So the net debt to equity ratio is only 0.1 times. And the valuations are also very attractive since the stock is trading at 13.5 times PE, well below its historical average of 19.5 times. Then finally, we like PLDT. Okay, PLDT, in our opinion, is a beneficiary of strong demand for data, with data right now already accounting for 70% of its revenues. Aside from that, PLDT has successfully turned around its wireless segment, and this is evidenced by the 12% growth in first quarter revenue. So, if you remember in the past, Smart actually lagged behind Globe because when people thought about internet access, um, they actually bought a Globe SIM card. But that has changed right now because Smart, I think, kind of realized that they were behind the curve. So they also launched promos on free YouTube, right? So because of that, it's actually gaining popularity, or Smart is gaining popularity, and right now they are able to capitalize on growing demand for data, even in the mobile phone business. And aside from that, I think what's more attractive about PLDT is that it has an advantage in the fixed lines business. Given that it has been around longer than Globe, so its fixed line infrastructure is actually more intensive. Therefore, right now kasi what's uso is people subscribing internet at home, and even getting fiber internet subscriptions, and PLDT is one of the major beneficiaries because it has the existing infrastructure. And another bonus would be in the future it will well, right now it's already benefiting from the growing popularity of mobile wallets through 48% owned Voyager, which is indirectly owns Paymaya. um, So in the future, there could be an IPO of this company. And of course, in an environment of low interest rates, the dividend yield of 5.6%, in our opinion, is very attractive. And that stock is trading at 5.7 times EV EBITDA, which is below its historical average of 7.2 times. So now moving towards stocks that are um, not as perfect, non-resilient. Well, earlier on, I said power companies were resilient, but among the more resilient ones, um, they're not as resilient because essentially, um, what happened was when people or businesses were locked down in in March and April, the demand for electricity also fell, and companies like Aboitiz Power will suffer because of that. And of course, because um, Aboitiz Power has large uncontracted capacity, falling WESM prices will hurt its earnings. It also suffered from unplanned outages. So anyway, WESM is like the spot market for power. If the demand for power is low, the prices in WESM go down. So AP is suffering from that. But that said, I think the worst is over for AP. The second quarter will probably be its weakest earnings. As the lockdowns were lifted, power demand is now at 90 to 95% of pre-ECQ levels. On a year-on-year basis, probably it's down around 10%. But I mean, a 10% reduction in revenues versus last year is actually not bad versus other companies which are suffering from more than a 50% decline in revenues, or more than 50% decline in sales. And of course, as the lockdowns are slowly eased, then of course we can see um, earnings just improving slowly over time. And of course, the long-term outlook of Aboitiz Power remains very good because it's a vertically integrated power company. It also has power distribution, not only power generation, and it has a well-balanced portfolio of power generation assets. So it has coal plants, it has hydro plants, so it can take advantage of different scenarios. And dividend yield is not as high as PLDT, but even with the depressed earnings in 2020, we expect the dividend yield next year to be 2.7%, and for 2022, 4.6%, which is not bad. And it's trading at 9.3 times next year's PE, which is below its historical average PE of 12.7 times. Then for the property companies, okay, we like Ayala Land and Mega World. Okay, so for the property companies, the most vulnerable to COVID-19 would be your hotels and malls, and to a certain extent, the residential property sector, because sales would be hurt by the pandemic as people earn less. The demand for properties would go down. But that said, the offices, to our surprise, was actually very resilient because the BPO sector um, continues to grow and demand for more office space. They said that work from home is not an option, especially for companies requiring um, more floor space because of the social distancing requirements, and of course for security reasons they cannot work from home. So demand for BPOs is still there, and companies actually trying to save money are actually looking for um, more to hire more people here in the Philippines and in other countries. They want to outsource. Okay. For me, what was surprising when we actually talked to property companies was that the residential sales were still strong because these companies are benefiting from lower funding cost. And so what they're doing right now is actually easing the payment terms, making uh, property purchases more affordable for buyers. And because they made the monthly amortizations cheaper, people are actually buying properties. I don't know if it's this week or last week, but Mega World disclosed that they actually booked around 17 billion pesos in take-up sales in the second quarter. And for the month of June alone, they booked around 7 billion. So that's a positive for us. Okay, so the reasons why we like Ayala Land and Mega World. First of all, Ayala Land office leasing is 10% of operating profits. Residential sales is around 57% of operating profits. We also believe that Ayala Land will benefit from a REIT or the upcoming REIT listing. In terms of valuation, it is trading also at a discount to its historical average PE of 28 times. For Mega World, well, actually, Mega World has a much larger office leasing business. It's around 35.9% of operating profits. And residential sales, around 45%. If you look at the mall business of Mega World, it's only 17%. So very small. And in terms of valuation, it's also much cheaper. In fact, it's trading below book value at 0.5 times price to book value. This just means that if you're buying the stock, you're buying it cheaper than the value of the properties that it bought several years ago. Okay, in terms of PE, it's 7.7 times PE. The 10-year average is 11 times PE. So really a very cheap stock to own. Other stocks that we like for long-term investors would be BDO and Metrobank. One of the reasons why people don't like banks nowadays is because of rising NPLs and falling net interest margins. But that said, we feel that the bigger banks will be less vulnerable because they have smaller exposure to the SMEs and consumer borrowers. Okay, bigger banks are more exposed actually to large corporates that are in a better position to pay their debts. So most likely the non-performing loans are not going to be as high because of that. And at least for this year, these banks will enjoy large trading gains because of falling bond yields. And this will help them cushion the impact of rising NPLs. So they can book more provisions given the large trading gains. So BDO is the largest bank, and it has very good quality earnings at as 86% of its revenues are recurring in nature. In other words, these are not uh, trading gains. They're more of interest income, fee income, and it's now trading at only 1.1 times price to book. The 5-year average price to book value of BDO is 2 times. Okay, Metro Bank, we continue to like it. It's the second largest bank in the country, and similar to BDO, it has minimal exposure to SMEs and consumers. Um, it is actually quite efficient because it's been conservative in growth the past few years. It is also highly capitalized. It has one of the highest capital adequacy ratios, and it's trading at a very cheap valuation of zero point 0.5 times price to book value. And in the past 5 years, it traded at an average price to book of 1.3 times. And finally, for consumer companies, we also like DNL. One of the reasons why DNL was sold down is because it's going to also be hurt by weaker demand uh, for its goods by restaurants and companies in the automotive industry. However, that said, it also has significant exposure to companies engaged in manufacturing of essential consumer goods. So, in other words, there's a certain level of resiliency in the company. And over the long term, we like DNL given its focus on specialization because this will lead to greater customer loyalty. Because if you have a specialized product that only DNL sells to you, then of course you're forced to continue buying from them. And aside from that, this has allowed the company to earn higher margins, and it will allow them to continue earning higher margins in the future. Aside from that, DNL has a very strong balance sheet with a net debt to equity ratio of 0.12 times, and it's now trading at 14.7 times PE, below its historical average of 24 times. So, as a recap, here are the stocks that we like: Pure Gold, CNF, CNPF, sorry, and PLDT. So these are stocks that you can buy right now, and these are the stocks that we recommend that you buy slowly for the long term. I'm less confident about the prices of these stocks going up in a straight line or being strong, but then again, given their valuations, it could be a good opportunity to start accumulating these stocks. So, what are the risks? I think, first of all, sentiment for traditional economy stocks, such as those that I mentioned earlier, that's part of my second list, could remain weak as earnings visibility remain poor. So in other words, if you buy stocks that are part of our second list, they might not go up in the short term because we're not yet sure how much earnings will grow or if they could remain weak next year. No, so that is a risk, which is why we're recommending for you to buy them slowly rather than buy them aggressively. Secondly, the ongoing measures to contain the COVID-19 outbreak could fail. And this could lead to some reimposition of restrictions or what we call a W-shaped recovery. In fact, that is one of the risks that is currently what people are worried about right now, not only in the Philippines but also in other countries. And finally, the development of a vaccine or a treatment takes longer than expected. Okay, so going to the vaccine development. So the problem is in the past, it took more than 10 years to develop a vaccine. Right now, we are at the clinical trial phase. So we're still not at the manufacturing and in the FDA approval stage, and a lot of things still could happen. Okay. And less than a third of vaccines and treatments that undergo clinical trials end up getting FDA approval. So still a lot of risk at this stage. So anyway, in summary, we're not expecting the market strength to be sustained in the short term since our economic recovery is expected to be U-shaped, not V-shaped. And the stock market is heavily weighted towards traditional businesses, while foreign investors continue to stay away from the market. However, neither do we expect the market to retest previous lows. Financial conditions today are better than in the past. And while most listed companies have already seen the worst, okay, the said factors should make selected stocks attractive to buy and to start accumulating. Okay, our stock picks for companies that belong to resilient sectors are Pure Gold, CNPF, and PLDT. Our stock picks for companies that belong to non-resilient sectors are Aboitiz Power, Ayala Land, Mega World, BDO, Metrobank, and DNL. For stocks that belong to non-resilient sectors, we recommend a slow accumulation with a long-term investment mindset, as there is a risk that these stocks will remain out of favor given poor earnings visibility. So with that, thank you very much, and I will join you again for the Q&A session later.